Hi, welcome to this series of Thursday Talks where we are taking up quant investing this month. So, demystifying, explaining, taking you through my understanding of what quant investing is. So, just a quick recap of what we did last week, which was, uh, what are markets? Markets are basically a reflection of the wisdom of crowds, and they keep changing their views based on new information that comes in. It's like a feedback loop because as new information comes in, it gets priced in. And usually over the longer run, markets are quite efficient and very hard to beat. In the shorter run, they are quite volatile and random. Investing can be of two types. It can be empirical or data driven, or it can be theoretical or ideas and theory driven. So we spoke about that. And what we said quant investing is what most people think is high frequency trading or it's high churn or it's just automated computer driven algorithms, um, a simple model, a cookie cutter model which everybody deploys across the board. It's not that. So, as we go along, we will show you that these myths are not true. Today, let's just see, you know, what is investing really? What now having in the market for investing for almost 2 decades now, having done my CA, MBA, written numerous articles, a book which is on its way. I feel like as we go along, and it may be a true metaphor for life also. It's like uh, every time I feel that I know something new comes along and I'm confronted with something that I didn't know before, and it's like slowly peeling off the layers of an onion, and you keep on saying that there's more to it, there's more to it, there's more to it, and you just keep learning, and as I think you feel very very certain in your 20s, a little less certain in your 30s and your 40s. If you're not feeling uncertain, you're not being true to yourself. Uh, I think it's more art, less science. Even quantitative investing or quant investing, rules-based investing, because ultimately you are the one who is uh, who is deciding on the rules. You have to design the rules, and anywhere where there is design involved, there is discretion involved. There is going to be a fair amount of art uh, involved. Thinking in terms of probability, I think, is one of the most important skills an investor should have, because we are always dealing with incomplete and imperfect information. There is no perfect information. There is no complete information. And when you are faced with that situation, you have to think in terms of probability. And so weighing the odds, uh, deciding whether this is a good investment or a good bet to take or not. I think, and being comfortable with that, having a process to do that, and honing your process as you move along. I think that is one of the most important skills that any investor, regardless of their style of investing, needs. It's extremely boring to in people think that it's a very, very exciting industry, something's happening all the time, but investing is not what you see in on TV shows like Billions or Scam or CNBC or any of these TV channels. Uh, and usually the principles don't change. Like Warren Buffett said that when he was 76, he said he's running things to the same thought process. Sorry, there's a typo there. It should be thought process that he learned from the book The Intelligent Investor. Again, okay, The Intelligent Investor that he read at the age of 19. So it is doing a lot of the same thing over and over and over again, and people in their quest for excitement or think that this is a casino where something new and exciting is going to happen, they they sort of mess up the whole process. And it is like an expression of one's worldview. And even though our end goal may be the same, which is to make money, which is to create wealth or grow our wealth, uh, the journey may be very different for different people. So there are many roads, to the same path. With that, let's jump into what is the basic framework and structure of quantitative investing and the approach that we want to take, and that is through factor investing. So, what is really, factor investing and what is quant investing? It's really, like I said earlier, it's an empirical approach to investing, which means it's based on experiments, it's based on practical experience, it's based on data. Uh, it it does that's the starting point. The starting point for other forms of investing may be an idea or a hypothesis, but here we start with data. And so, what in this form of investing, what investors seek to do is study why a particular stock or market or portfolio or an index has done well, and try and identify or isolate those factors, and to which explain the performance of the portfolio of comprising of either different asset classes or different stocks, and see if they can identify something unique uh, about that portfolio. Whether it was value portfolio where value in factor terms is understood as buying something that is undervalued or cheap in statistical terms, or quality stocks which are defined as stocks maybe having high profitability or high ROE consistently, return on equity, or momentum stocks that have done well in the last 3 to 6 months or 9 months, 9 to 12 months, and are expected to do well in the next 3 to 6 months. Do these set of factors explain the performance of that portfolio? If they do, then we can say that this is likely to uh, sort of persist in the future. And of course, this has to go through a lot of testing, a lot of robustness checking, a lot of you know uh, it has to pass the high barrier for it to be implemented. So factors have to be persistent throughout time. They have to be robust. They have to be proven across asset classes. So they have to be pervasive. And unless we are, and so very few factors pass these high bars. At present, there are about 5 or 6 of these factors. Um let's take an example to try and explain an example. This is a fun example. So let's say that, every time an investor, let's call him RJ, appears on television, the market moves appear to be stronger. So his appearance becomes like a proxy or a substitute for systematic risk. That, every time this factor appears, the market seems to move faster. How are you going to put it in the way of an equation? The way we put it in the equation, the relationship would be that the expected return from the market or the portfolio would be the risk-free rate of return plus the B, which is the beta, into the number of appearances by RJ on television plus randomness. There's always some amount of randomness. So if there is a strong relationship, then the beta must be higher. That means that stock or portfolio or index must be sensitive enough to the appearances by RJ on television. So, like I said, besides randomness and risk-free rate, if the index or stock has strong beta, or beta is nothing but sensitivity with respect to the RG appearance, we're calling it the RG appearance factor. Then all else being equal, the index or stock should have higher returns in the future, which means that if RJ's appearance factor is high, let's say it's 10 or 20, then and the beta is also high, it can be anything from negative to positive in a certain range. Let's say it's 1.5. So 1.5 into the number of appearances by RJ plus randomness plus the risk-free rate will give you the expected return on the portfolio over the long run. Remember, these are very long-term expectations. Don't expect them to sort of give you results uh, instantaneously. But broadly, this is the way it would the construct would appear. So with that, we'll end it today, and next week we'll go into some real life examples and factors. Today was just to explain to you, uh, how what is the basic construct of a equation, or how do we go about the thought process of quantitative investing. So the disclaimer: nothing in this video should be considered as investment advice. It's purely for educational purposes, and please consult your investment advisor before investing. And you can follow me on Anish Daily at QEDCap, at Anish Daily, or visit us at qedcap.com. We keep getting your queries and responses, so do like and subscribe and follow our YouTube channel. And we'll see you again next week. Until then, have a good week ahead, and see you next week.